You're not going to believe what just hit the silver and copper market. President Trump just triggered a 180-day countdown that could force a new minimum price system on critical minerals. Yes, including silver and copper, using trade negotiations first and hard restrictions after. And if those talks fail, the government has a clean path to step in and reshape the price you see on your screen. That's what happened. That's the event. And in the next few minutes, you'll see why this is bigger than a headline, why the first move in price might be the smallest move, and why the real shock could land on day 179 when everyone thinks the clock is still ticking. And here's why you should stick with me to the end. The first headlines will focus on tariffs that haven't happened, while the real weapon is the minimum price mechanism hiding in plain sight. I'll break down how that mechanism can force buyers to front-run supply, why a successful deal can still raise prices, and the one signal that tells you the smart money is accumulating. Miss that signal, and you'll only show up after the move. And pay the premium. Before we go deeper, quick favor. I'm running a campaign to push back on copycat channels that rip original work and repost it. If you want to support the real thing, hit subscribe and comment OG John AG below. And one more thing. If you want daily updates, quick posts, my personal takes, plus instant voice notes and fast alerts that I don't put on YouTube, I made a WhatsApp channel for this. Link is in the description. Join it, because when markets move, speed matters more than opinions. Now, let's talk about what this proclamation actually means, without the fluff. And the consequences can get loud. Because the plan isn't only about one metal, it's about a basket. Materials that power batteries, grids, weapon systems, electronics, and the next wave of industrial competition. Lithium, nickel, cobalt, rare earths. And then the two names that make the market react like someone yelled fire in a crowded room. Silver and copper. Here's the twist. The first step is not tariffs. The first step is price floors, negotiated with allies. Basically a coordinated minimum import price designed to stop what they call predatory pricing and to stabilize supply. It sounds polite. It sounds technical. It sounds like paperwork. But price floors are not paperwork. Price floors are power. A price floor is the demand-side cousin of a tariff. A tariff hits you with an added cost. A price floor tells you this product cannot enter below a certain price, period. And when you enforce that at scale, you're not just changing trade, you're changing the entire incentive structure for producers, refiners, and buyers. Now watch this carefully. There are no tariffs yet. That's important. No immediate, we just slap 25% on everything. Instead, they set the clock. 180 days. Negotiate, align, coordinate. Then, if it fails, minimum import prices and Section 232 style restrictions are sitting right there, ready to be used. And Section 232 is not a tiny tool. It's a national security lever. It's the kind of lever that can move entire industries, which is why the market doesn't wait for day 180. The market starts gaming the ending today. Now, some of you are thinking, okay, but 180 days, why that number? And the answer is, it's long enough to look reasonable, but short enough to create urgency. It fits a procurement cycle, it fits a political cycle, it fits a negotiation cycle, and most importantly, it fits a market cycle. Because 6 months is the perfect window for institutions to reposition without admitting they're repositioning. Here's what that means for you. In the first month, you get headlines and confusion. In the second and third month, you get progress stories, leaked talking points, and sudden optimism that makes people relax. In months 4 and 5, you get pressure, deadlines, threats, final offers. And that's when the real buying often starts, quietly, because the big players don't want to be seen chasing. Then you arrive at month 6, where the public wakes up and says, wait, so what happens now? And by the time the public asks that question, the smart money has already chosen its side. So if you're still treating this like a one-day news event, you're already behind the script. Now let me explain price floors in a way anyone can understand. Think of it like this. If the government says, we will not allow imported processed silver or copper products to enter below a certain price, then the cheapest supply disappears overnight. Not because the metal vanished, but because the rules changed. And when the cheapest supply disappears, everyone competes for the next cheapest supply. And that's how floors can lift the entire curve even without a single new buyer. But floors come with enforcement. You need reference pricing. You need documentation. You need audits. You need penalties for misreporting. You need anti-circumvention rules, so companies can't relabel products and sneak them through a different category. And that's why a floor is not just a number, it's a system. And systems create winners. If you're allied, transparent, and already inside the preferred supply network, the system is a tailwind. If you're outside, the system is a wall. Now, watch how the narrative battle will play out, because this is where people get emotionally tricked. One side will say, this is protectionism, this is market distortion. The other side will say, this is national security, this is resilience. Both can be true at the same time, and while they argue, the only people who consistently win are the ones who position early and manage risk. That's why I keep returning to the same idea. The point isn't to be right, the point is to be ready. Now let's talk about Section 232 for a moment because people hear it and shrug. Section 232 is the legal lane that treats trade as a security issue. And when something becomes a security issue, it gains political priority. That can mean quotas, it can mean tariffs, it can mean restrictions on specific product forms, it can mean carve-outs for allies and crackdowns on everyone else. And it can arrive fast, especially if negotiations become a public embarrassment. So the countdown is also a credibility test. If leadership says, we will fix this dependence, and then does nothing, it looks weak. If leadership says, we will fix this dependence, and follows through, it looks strong. Guess which option politics usually chooses when the spotlight is bright. Now, here's a fourth cliffhanger that most people won't see coming. Even if negotiations succeed, you can still end up with higher prices. Because a successful negotiation can still include a minimum acceptable pricing framework. It can still include commitments to avoid dumping. It can still include coordinated stockpiling. It can still include voluntary limits that function like restrictions. So don't assume a deal equals cheap metal. A deal can be the mechanism that makes the floor legitimate. Now, let's run 3 scenarios quickly and tell me in the comments which one you think is most likely. Scenario 1, smooth agreement. Allies coordinate. Minimum pricing is quietly accepted. Supply keeps flowing, but at a higher, more stable price. Volatility cools down. Everyone pretends it was always obvious. This is the adult in the room outcome. Scenario 2, messy agreement. Talks drag. Headlines flip daily. Markets swing violently. At the last moment, a patchwork deal is announced, full of exceptions, loopholes, and side conditions. Prices whip around because nobody trusts the details. This is the we avoided disaster, maybe, outcome. Scenario 3, breakdown. Negotiations fail. Minimum import prices and restrictions come in. Retaliation threats hit the tape. Buyers rush to secure supply. Miners and processors become strategic assets, and the market reprices the entire complex fast. This is the shock and awe outcome. Now here's the scary part. Even if you think scenario 1 is coming, the market can still trade scenario 3 for weeks at a time, just because the risk exists. So risk management matters. Now, I'm going to bring this back to the ground level again. What should you literally watch for in the next 180 days? Watch for announcements about joint stockpiles. Watch for language around secure processing and trusted supply. Watch for new funding programs, loan guarantees, fast-track permits, or strategic partnerships. Watch for procurement changes in defense and infrastructure projects. Watch for sudden shifts in export rules from other countries. And watch for the quiet signal, long-term offtake agreements. Because offtake agreements are where the future gets priced. Now, let's tie this to what you saw on the tape one more time, because this is how you keep your head clear. A violent sell-off after bullish news often means one of two things. Either the market was overcrowded and needed to shake people out, or the market is sniffing something else, like a side deal, a carve-out, or a macro risk, before you see it in the headlines. So don't guess, observe. If silver and copper stabilize after the first shock, that's information. If they keep cascading without bounces, that's information. If they bounce but volume dries up, that's information. If they bounce with sustained demand, that's information. This is why I love short paragraphs. The market speaks in short bursts too. Now, I'm going to say something that will save you pain. Do not treat miners like lottery tickets. If you're going to touch miners, treat it like a business analysis. Look for reserves, jurisdiction, permits, balance sheet, and the ability to finance without destroying shareholders. Because the moment policy money shows up, the best companies get stronger, and the worst companies get louder. And loud doesn't pay you. Execution pays you. Now, if you want, in a future video, I can break down a checklist for mining due diligence. Again, without pumping anyone, just teaching the filter. If that's useful, type miner's checklist in the comments so I know what to make next. And I'll ask one more engagement question because I'm genuinely curious. Do you think government setting price floors is a sign of strength or a sign that the free market era is ending? Tell me what you think because this is bigger than a trade story. It's a philosophy shift. All right, back to the main thread. So what did traders do? They did what traders always do when a real structural story hits a highly emotional market. They overreacted, then they fought about it. You saw volatility. You saw fast selling. You saw sharp bounces. You saw people calling the top, calling the bottom, then calling each other idiots, sometimes all in the same hour. Silver dropped hard, then got bought, then slipped again. Copper got hit. Energy moved. Yields wobbled. Stocks did their own thing like they usually do, pretending metals are someone else's problem, until they aren't. And if you're wondering why the selling can be aggressive even on bullish news, it's simple: positioning. When too many people are already leaning one way, bullish news becomes an excuse for short-term profit-taking, liquidation, and forced rebalancing. The story can be bullish while the tape is ugly. But don't get hypnotized by the first candle. The first candle is rarely the real message. The real message is what happens after the market has time to think. Because this 180-day countdown isn't just about price, it's about control. Here's what many people miss. If a government sets or enforces a price floor, it's effectively choosing the minimum revenue that foreign supply must receive to enter the domestic system. That can redirect flows. It can attract supply. It can starve competitors. And it can pull forward production decisions that would normally take years. And then there's the part nobody likes to say out loud. If you can set a minimum price, you can also justify stockpiling. You can justify subsidizing domestic refining. You can justify building capacity. And you can justify stepping into markets temporarily until stability returns. Temporary programs have a funny habit of becoming permanent institutions. So, if you're asking, is this bullish for silver and copper? The answer is, it can be bullish in a way that doesn't look bullish at first. Because in the early phase, you can get chaos. You can get bargaining. You can get diplomacy headlines that sound like relief, and then end up being a trap. Let me show you the trap. Imagine a deal. We'll give you access to X if you give us access to Y. Markets love that. Markets hear deal and they buy risk. They sell fear. They relax. But if the deal involves swapping strategic resources, rare earths for energy, metals for technology, supply for security, then the deal can also cap upside in some places while exploding it in others. That's why I'm telling you, don't just watch prices. Watch the structure being built behind the price. Because once a structure is in place, it changes how every dip and every rally behaves. Now I want to pause for 2 seconds and make something clear. I'm not here to tell you to panic buy. I'm not here to scream, "to the moon." I'm here to map the chessboard, and the board is changing. If the government is serious about reshoring strategic supply chains, there are 2 unavoidable outcomes. Outcome 1, higher guaranteed pricing in some parts of the chain, because you need producers to invest. Outcome 2, money flows toward the companies that can actually deliver real supply. Not the loudest tickers, not the best marketing, but the operations that have reserves, permits, and a path to production. And that's where the opportunity and the danger live at the same time. Because people hear silver and they think only about coins and bars. But governments hear silver and copper and they think wiring, defense, electronics, grid upgrades, and industrial capacity. Different buyers, different time horizons, different pain thresholds. If you're watching from home thinking, okay, John, so what do I do with this? Stay with me, because in a minute we'll talk about what this could mean for physical metal versus miners, and why some of the biggest upside may not be in the metal itself, but in the picks and shovels. But first, one quick creative plug. If you want silver success stories from real people, there's a separate channel linked in the description. Subscribe there too. It's quick inspiration for staying disciplined when the market tries to shake you out. All right, back to the countdown. What is the government really trying to stop? They're trying to stop being held hostage by a handful of foreign choke points. Processed critical minerals are the bottleneck. It's not just, do we have metal in the ground? It's, can we refine it, process it, convert it into the form industry actually needs, and do it reliably? And when a probe labels that dependence a national security threat, you've crossed into a new category. This is no longer trade policy. This is strategic policy. And strategic policy doesn't ask permission from markets. It tells markets what the new game is. Now, this is where price floors become a big deal. A negotiated floor with allies does 2 things at once. It blocks ultra-cheap supply that undercuts domestic investment, and it gives producers confidence that if they expand, they won't be destroyed by sudden price dumping. That is the sales pitch. That's how it will be framed. But on the ground, it means the state is leaning into pricing. And when the state leans into pricing, one question becomes unavoidable. Who gets favored? Because not every producer wins under a floor. The winners are the ones who are compliant, allied, and strategically useful. And the losers? They can still sell, just not here, or not at that price, or not without constraints. So even before day 180, companies and countries start repositioning. Some rush to sign, some stall, some threaten retaliation, some offer side deals, some try to break the coalition. And in the middle of that chaos, The market is trying to guess one thing. Will the negotiations fail? Because if they fail, you get the heavy tools. Minimum import prices, Section 232 restrictions, and potentially a broader set of actions that no one wants to spell out in a press release. That's why this is a countdown story. It's not one decision. It's a sequence. And sequences are where cliffhangers live. So let me give you the first cliffhanger right now. The 180 days may not be the real deadline. The real deadline is when large buyers decide they can't risk waiting. When manufacturers start whispering, "We should secure supply now." When procurement teams decide it's cheaper to lock in today than to gamble on policy tomorrow. That's when stockpiling begins, not by governments, but by the private sector trying to front-run the government. And that's when the price can move in a way the charts can't explain. Now let's talk about the market action you saw, because it wasn't random. Silver had a violent move down, then a fast buy. That usually tells you two groups are fighting. Group 1 is leveraged. They get forced out when volatility hits. Group 2 has conviction. They step in when price hits a level they consider unfair. And here's what makes this moment unique. If price floors are coming, unfair levels become easier to define because policy creates an implied backstop. Even if the floor isn't official yet, the market begins to price the possibility. That's why you can see a falling knife get caught, even while the headlines are still being digested. But be careful. A caught knife can still cut you, because the day is not over until the day is over. And in markets, the second wave is often worse than the first. So what should you watch? Watch how price behaves around key levels after the first bounce. If price breaks below support, keeps going, and closes weak, then the structure is dominating, and you can see another leg down. But if price dips, snaps back, and holds, then you're seeing accumulation under stress. And accumulation under stress is how big moves begin. Now, I know some of you love pure chart talk, and some of you hate it, so I'll keep it simple. The chart is not the story. The chart is the scoreboard. Policy is the game, and the game just changed. Now, earlier I said the opportunity may be less in metals themselves and more in miners. Let's unpack that without hype. If the government wants secure supply, it needs production. If it needs production, it needs investment. If it needs investment, it needs profitability. If it needs profitability, it needs price. That's the chain. So a price floor, even as a negotiated concept, is basically saying, we might guarantee your economics. And that can re-rate the companies that were previously ignored because capital was too expensive, or because projects were too early, or because the market didn't care. But, and this is a huge but, most mining companies are not built the same. Some have real reserves, some have dreams, some have permits, some have PowerPoints. Some have management that can execute, some have management that can only raise money. So the opportunity is not miners go up. The opportunity is the right miners get an extra tailwind. And that tailwind isn't just the metal price. It's policy support. It's access to funding. It's strategic partnerships. It's a political incentive to make sure certain projects survive. And if you catch a company that gets the metal move plus the policy move, you can get a multiplier effect. But if you catch the wrong one, you get dilution, delays, and disappointment. So if you want me to do more content on how to think about miners, let me know below. Because I can go deep on what to look for, without naming names, without pumping, just teaching you how to filter. Now, 2 questions for you, and answer honestly in the comments. Do you think the 180-day negotiations end in a calm deal? Or do you think they end in restrictions and shock? And second, if silver and copper become strategic, do you think the average investor is early or already late? Drop your thoughts below. I read more than you think. Now, let's talk about the bigger macro backdrop that makes this proclamation feel like gasoline on dry grass. We're in a world where every major economy wants the same thing: growth without pain. And the easiest way governments try to buy time is by weakening currency and subsidizing industry. That's not a conspiracy. That's policy. And when multiple countries do it at once, you get competition, not just in trade, but in industrial capacity. That's why critical minerals are a battlefield now. Not because metals are shiny, because metals are leverage. If you control the inputs, you control the outputs. If you control the outputs, you control the economic engine. And if you control the economic engine, you control bargaining power. So a proclamation on imports is actually a chess move in a wider resource contest. Now here's the second cliffhanger. If price floors get discussed for critical minerals today, what gets discussed next? Because once a government normalizes intervening in one strategic market, it becomes easier to intervene in another. And the market hates uncertainty until it learns how to profit from it. So the first movers get paid, and the late movers get punished. That's why I keep saying, pay attention to structure. Now, I also want to address something that can confuse people. You might see oil falling on a day when you expect geopolitical fear to push it higher. You might see stocks rally when you expect policy risk to push them lower. You might see gold soften while silver whipsaws. That doesn't mean the story is false. It means the market is a messy machine of positioning, liquidity, and cross-asset flows. Sometimes the cleanest headline gets drowned by the loudest forced trade. So don't let one day's tape trick you into abandoning the bigger frame. Because the bigger frame is that governments are signaling they will not tolerate supply dependence. And once that signal is out, it doesn't go back in the box. Now, I promised we would talk about physical metal versus miners, and here's the honest answer. Physical metal is about ownership. It's about removing counterparty risk. It's about having an asset that doesn't depend on a CEO, a board, a permit, or a quarterly report. Miners are about leverage. They can move more than the metal, but they can also fall more than the metal. So which one is better? It depends on your goal. If your goal is safety, you lean physical. If your goal is upside, you research miners. If your goal is balance, you can split. But whatever you do, don't confuse the two. Because when policy shifts, physical can become scarce, while miners become politically useful. And politically useful is a strange kind of bullish. It can mean support, it can also mean scrutiny. It can mean subsidies. It can also mean rules. So the playbook is not buy and forget. The playbook is buy and stay awake. Now, let me bring this back to the 180-day timer again, because the timer is the psychological weapon. It tells everyone in the supply chain, decide. It tells allies, get on board. It tells producers, prepare. It tells buyers, secure. And it tells speculators, front run. That's why you're going to see narratives collide. One day you'll hear, the floor is coming, buy the dip. Another day you'll hear, talks are going well, crisis averted. Then you'll hear, talks stalled, restrictions likely. Then you'll hear, a surprise agreement is near. And through all of it, price will swing to punish late decisions. So here's a simple way to stay grounded. Ask yourself 3 questions every week during the countdown. What did policy do? What did big buyers do? What did price do after the first reaction? If you can answer those 3, you'll be ahead of most people who only react to headlines. Now I want to give you another quick reminder. By the time you're watching this, a members-only video should already be live, where I put all the latest updates in one place and go more in depth than I can here. If you want that premium breakdown, join the membership. It also shows me who's really following and supporting the work when it matters. And yes, in the membership, I'll be sharing deeper analysis as this countdown evolves. Now, since we're talking about support, let me say this as politely as I can. Now back to the core story, because there's another layer. Negotiating price floors with allies implies coordination. Coordination implies shared enforcement. Shared enforcement implies shared intelligence. And shared intelligence implies that countries are mapping each other's vulnerabilities. So while the public hears trade talks, the private game is resource alignment. And that can escalate quickly, because if one side feels boxed out, it looks for alternative routes. New buyers, new suppliers, new corridors. And in a world already tense, supply corridors can become political flashpoints. So the 180 days isn't just a timer on economics, it's a timer on relationships. Now, let's talk about why silver and copper are singled out in attention, even when they're listed alongside other minerals. Copper is the bloodstream of electrification. Every grid upgrade, every data center build-out, every EV rollout, every industrial modernization plan has copper in it. Silver is the quiet workhorse of electronics and high-performance applications. Plus, it sits at the intersection of industrial use and monetary psychology. So when policy touches these two, you get both kinds of demand narratives at once. Industrial demand plus strategic demand. That's why volatility can spike. Now, I want to address the price floor concept again, because people hear it and assume it's bullish immediately. It can be, but there's a timeline risk. If the market believes the floor is coming later, it may sell now and buy later, trying to time the confirmation. If the market believes diplomacy will solve it, it may fade the story and punish weak hands. If the market believes the floor is coming and it will be enforced aggressively, it may front-run hard and create a blow-off move that later retraces. So the floor creates optionality, not certainty. But optionality is still valuable, because it changes what's possible. Now, if you're still with me, here's the part that should make you sit up. This is not just about restricting imports. It's about rewriting the rules for processed materials. Processed. That word matters, because it implies the bottleneck is not the mine alone, it's the refining and conversion step. And if the U.S. wants less dependence, it will push investment into domestic processing, allied processing, and secure processing, which means capital spending, which means long-term contracts, which means guaranteed offtake agreements, which means, again, the kind of support that can re-rate specific operators. So if you're only looking at spot price, you're missing the deeper current. Now, let me speak to the mindset for a second, because retention is about not losing the plot. People love the drama of up big and down big, but the real wealth usually comes from understanding sequences. If you can see a policy sequence forming, you don't need to predict the exact tick. You need to position for the direction of the machine. And the machine is moving towards strategic industrial policy. Now, quick friendly ask. If you are someone who has done well in metals, trading, investing, business, anything, share your success in the comments. Not to brag, to give other people hope and a realistic model. Your story might be the thing that keeps someone disciplined instead of emotional. All right, so where does this go next? In the near term, expect more headlines about negotiations. Expect more sources say pieces. Expect commentators to argue about whether price floors are good or bad. Expect exporters to lobby. Expect importers to panic. Expect traders to use every rumor as a reason to swing price. And in the background, watch for signs of stockpiling and procurement changes, because those are the quiet confirmations. Now here's the third cliffhanger. When the state starts talking about securing supply, it often follows up with infrastructure spending. And infrastructure spending doesn't just boost metals demand. It boosts the demand for equipment, labor, energy, and financing. So if you see a push to rebuild processing capacity, the second-order effects can show up in places people aren't watching. And those second-order effects can create surprise winners. So don't just watch silver and copper, watch the ecosystem. Now I want to bring the story back to the human level. Why should you care? Because when policy shifts, prices can gap, and gaps don't ask your permission. If you're unprepared, you watch. If you're prepared, you act. So the takeaway is not buy everything. The takeaway is understand the map and have a plan. Now, let's recap the event in plain English. A national security investigation warned the U.S. is too dependent on foreign processed critical minerals. The response was a proclamation ordering negotiations to adjust imports. The negotiation period is 180 days. The goal is to pursue minimum pricing with allies, price floors. If the negotiations fail, stronger trade actions can move into place, including minimum import prices and national security restrictions. Silver and copper are explicitly caught in that net. That's the story. And the reason I'm making such a big deal about it is because it signals a willingness to intervene in market pricing for strategic materials. Now, I'm going to end with a forward-looking question that I want you to answer in the comments. If governments start setting floors, do you think the next move is higher prices or tighter supply? Because the truth is, it can be both. And depending on how it plays out, you'll want different strategies. So tell me what you think. And if you got value from this breakdown, do the simple thing, subscribe. Join the WhatsApp channel in the description for the daily premium updates and voice notes. And check the members-only video that should already be live for the full in-depth rundown. I'll see you in the next one.